Well, it is June, and guess what, my friends? It's tax time. Firstly, editorial note, I want to apologise because I forgot to do this episode. I usually like to get the tax episode done end of the kind of May because there's no point doing tax planning in July. You have to really get that sorted into June. So this episode is going up the first week of June. We are recording it on, what's the date today, Ben? The 2nd of June.
2nd of June.
And I am joined by Ben De Rosa. Is that how I pronounce De Rosa, Ben?
That is Ben De Rosa, correct.
Love it. And your business is Aevum Accounting.
That's right. Aevum Accounting. Yep,
Yeah.
you nailed that one as well.
Well, I'm just here for it. People need to know a couple of things around tax because it's an Australian government federal thing. Your tax accountant doesn't have to be in your city or state.
That's correct. Yeah, we've got lots of clients all over Australia.
Yep.
And yeah, like you said, it's not a state-based thing. We do Google Meets with our clients and help a lot of clients that are over east or in WA as well.
Yeah, so Ben is from the West Coast. We will hold that against him. But helping people all over Australia. We're literally just going to go through and answer a heap of questions. If it's your first time listening to the podcast, we get a lot of our content from questions in the Facebook group. If you do want to join the Facebook group, just say that you heard Glen and Ben on the tax time episode. That Facebook group is called Money, Money, Money Podcast or something like that. Forget what it's called. And we won't know that you are spam if you put that you've heard both of us on here. If you need an accountant to do your tax return, we'll put a link to Ben's business in the descriptions and all that. Otherwise, my name is Glen James and we're going to do a show about tax. How boring, right now. Before we get into it, this show is general advice only. I've got a license to provide that advice. Full details can be found in the show description. My name's Glen James, former financial advisor. I host this show and a show called Retire Right. I've got some books, the award-winning Quick Start Guide to Investing and the Quick Start Guide to Your First Property, available where good books are sold or in the description. If you're new here, welcome. If you're an old hand, welcome to M3. Let's get into it right now. Okay, Ben, you dirty dog. The first question here from Lavender Kale or Anonymous. It's probably just going to be anonymous on the screen. What are some triggers in your financial situation where you might consider an accountant over DIYing your tax return? E.g. moving from PAYG, and that's pay as you go, like an employee, everyone, to running your own business, buying an investment property, share portfolio over a certain value, etc. So when is a good time to be a DIY and when isn't?
I would probably say all of the ones that you just mentioned there. So investment properties, sole trader business, because you never know, it could grow quickly. You might be missing deductions as well. And then obviously managed portfolios, a lot of them are pre-filled now. So maybe if you've only got one or two, you might be okay doing it yourself. A lot of the ATO have a lot of information. So, and generally the managed portfolios are released around October. So you could get away with doing it yourself. When it comes to maybe selling those portfolios, you might need someone at that stage to help you with the capital gain side of things. But we offer a free 15-minute initial consult. So if you're not sure, you can book that in with us and we can just have a quick chat to see if you do need one or if there's anything you're missing. We also have a lot of information on our website about investment properties and information like that. But I would probably, if you're more than your standard deductions and your PAYG, you'd probably reach out and see what an accountant can offer. You could always test run it for 1 year and then go back to doing it yourself if you didn't think you found much value.
Yeah, and it is important to note that if you do pay an accountant, you can claim that fee in next year's tax return, so it's effectively tax deductible, right?
Yes, that's correct. Yep, you'll get the tax back on the amount that you've paid your accountant, and hopefully they'll get you more back than what you've paid as well.
So it's important for, I think, anyone, whether you're using an accountant or DIYing. We know the end of the financial year is 30 June. But we probably shouldn't log in and do our tax return the first week of July, should we?
Yeah, that's correct. I wouldn't be jumping straight in there. A lot of the single touch payroll that they've got now, your employer usually won't submit that until. I know a lot of paramedics, for example. We deal with a lot of paramedics with St. John. They don't file theirs till about the 14th of July. So I probably wouldn't jump in until the first couple of weeks that have come through, because it might not be complete and you might get whacked with an audit if you've missed anything from there.
And some of the, you mentioned the managed accounts like ETFs and all like managed fund types statements, you might not get the tax reporting documents for the end of the financial year until September anyway, right?
Yes, that's right. They're getting quicker with everything being electronic now. Previously, we'd be waiting till November. So we'd either be, piecing things together with part information that we've been given from the client. So if you're doing your return yourself, you might miss that altogether. We have seen just over the last tax year, 2025, probably September, like you mentioned, they are starting to come out a bit quicker, but some of the ones, especially if they're international shares or ETFs, sometimes they can take a little bit longer as well. So, waiting that little bit of time can make sure that you pick everything up. Obviously, you've got interest as well, which is pre-filled. The banks, again, they're getting way quicker than they used to be. But sometimes some of those other banks, I think, maybe Bank sometimes takes a little bit longer, just off the top of my head. But again, with everything becoming electronic, they're probably getting quicker and quicker.
Of the DIYs out there, like obviously we were talking before we press go, and you've been an accountant for 350 years at this point, so you've seen a fair bit. Are there main things that stick out to you when you are amending a return, or you're looking at last year's return if they were a DIYer? Like, what are some of the tripwires that the DIYers don't pick up themselves, which they need to look out for?
I think a lot of people that come to us from other accountants, that might just be your shopping centre type of accountant, they wouldn't have asked the client many questions. They just slap it together with whatever you bring in. And I think if you're paying an accountant that is either getting annoyed that you haven't got everything there in the meeting, in the one appointment, and not sending you away to get stuff after, they're probably not doing like a complete service. So motor vehicle expenses, home office as well, the hours that you're working at home, especially obviously COVID was a bit, a while ago now, but it definitely is something that people miss. Headphones, electronics, stuff like that people haven't really thought about claiming for their home office. So, they're probably the things, off the top of my head that people might miss.
Yeah, awesome. Following on for that working from home stuff, there's a question here from Jason. Are you better off for ease doing the fixed rate method when working from home, or take the time to work out the actual cost method? And maybe you could explain both of those methods.
So with the home office, we generally could do the hours method. It tends to work out better, especially because if you're not seeing clients in your home and you're not actually running an office, you can't claim like your council rates or your interest or a lot of the other expenses. You can only use the electricity, the gas, and it has to be apportioned based on the floor space of the home office, which a lot of people, their home office isn't going to be more than 5% of their home. So the cents per hour method usually works out, 99% of the time works out better. We still tell clients, we ask them both, and then we compare both methods as well. But we say generally the hours method will work the best. And then on top of that hours method, then you can claim, like your printers and any other home office equipment if you've still got that separate home office. So the answer would be the hours method tends to work out better, than the two different methods.
So, it is the end of June. It might be too late now, but if someone is working 3 days a week from home, or they might be in Victoria now, and I think it's mandated that everyone has to work from home or something like that. Sorry, I just cracked myself up, whatever. I need a live audience. Come on, Ben, give me some love.
Sorry.
I forgot you're an accountant. Boring. From the start of July, when we is it worth just doing like a Google sheet or an Excel thing and just starting to list the things, noting that we're not self-employed, but we're an employee and we work from home, and just maybe list over the month what the power bill is, the internet bill, and just log the actual hours that we are working each week. And just if you do it each week or each month, if you're working from home, it makes this time next year so much easier because you're just like, there it is, gift wrapped.
Yeah, definitely. You can certainly prepare things. If the ATO, I've only had, I think it was like maybe 2 audits in the last 17 years. And when they check the home office, they ask for basically a diary of the hours that you're working from home, and they've accepted an Excel spreadsheet which has the days and then the hours that are on there. They might just check with your employer or get you to write a letter about what you actually do at home and the days that you're home, see your timesheets or something like that as well. But we can generally you can go back through your bank statements and pick out those electricity receipts if you haven't, pre-prepared, like you mentioned. Obviously it's good to keep track of it as you go along. You can drop it into a Google Drive, OneDrive, have all your electricity bills, add them all up, and then we can ask you what the floor space is of the home and compare both methods.
As a question on that, and this is useful because, like, for example, I've got 3 team members that work from home 100% of the time, right? If someone was renting and they had a home office, if they're a small business, obviously we can claim a portion of the rent if you're a sole trader or whatever, or rent it, have your company pay rent maybe personally, I don't know. But I think what I'm trying to say, if you're an employee working from home, you can't prorata the hours for your office. Is that what you said before? Like it's only those running costs?
So if you're not seeing clients at home, so if you're just an employee and they're working at home, editing or producing, then they can only claim the electricity, the gas, and then apportion that. So you can't claim rent. You couldn't claim council rate strata if you own the place. You're only limited to electricity and gas, really. So
and internet?
If you apportion and internet, if you were to apportion those expenses and it was only say 5% based on the home office size, because it's not based on the hours that you work, it's only the home office size. Generally, if they're working full time, the hours method at that cents per rate is going to work out higher. So unless they were, like you mentioned, running a small business at home, and they were even if they were running a small business at home, you would still need to see clients or be actively running the business at home to be able to claim council rates, rent, all that sort of stuff as well. So you're kind of limited if you're not actually seeing clients from home.
Yeah. And I think in rounding off kind of this segment, like if you are someone with a share portfolio, someone with an investment property, or someone self-employed, friggin' just pay an accountant to make sure that you've maximized everything. Get on with your life. Honestly, what are we doing here?
Yeah, I think definitely a lot of clients come to us, even if they don't have investment properties and stuff like that. They just come to us because we might be able to do the return for them in 30 minutes. They'll be sitting there trying to log into MyGov, link it all up, and it might take them hours. And they still might think that they've missed stuff. So, definitely we've got more complex stuff.
Yeah, what do you guys, and this is just, don't, if you're listening to this in 2030, don't hold Ben to it. But like at the moment, what's kind of the price for an ITR at your firm for an individual?
Yeah, so we have 2 options. We have an email tax return, which is our cheaper option. We have so you book the email tax return in with us. It's $330 is the base rate. Yeah. We send you a online checklist, ask you heaps of questions about deductions. You can upload all your expenses. We can also help release that checklist to you the year before. So like you said, if you want to keep track of stuff, you can upload it into this portal so it's ready to go for the end of the year. But the email tax return is $330. Then if you add a investment property on, it's another $100 on top of the $330. If you've got capital gains, if you provide us the buy price and the sell price, then it starts at $100 as well. And then the other option is if you don't want to do it online, you want to have a meeting, whether it be through Google Meet or coming into our office, it starts at $440, and then the same prices, you just add on the $100 for the investment property or the $100 for the capital gains schedule as well. And generally sole traders as well, if they're reasonably basic, it'd start at $100 as well, just on top of that $440 price or the $330 price. Yeah.
Yeah, sweet. Thanks for that. back off, buddy, because Steph has got a question. My understanding is that the government has said everyone gets an instant 1K deduction on their tax return. Do we still have to claim this, or will it be auto-applied? If we're using this, do we not use the work from home stuff? What's this 1K reduction or the instant deduction? And is it this year or next year?
Yeah, it's a really great question from Steph. It is next year, so you're correct. A lot of people, I think, are going to be coming to get their tax done and be like, I want the $1,000. So we're going to have to say, no, you're going to have to wait. It starts 1st of July 2026, so it'll be the 2027 tax year. So it's not actually passed Parliament yet either, but it's just replacing the 300. So at the moment, you can claim up to $300 worth of expenses without receipts. You only get the tax back on that. So depending on which tax rate you're on, you're probably not going to get too much more than $300 from the 1,000 and, $100 from the 300. So, it's not like you just get 1,000. You also have to claim it in your tax return. And if you go over the 1,000, you then have to have receipts and expenses and proof of all of your expenses. So, a lot of clients will jump over that 1,000 very quickly. So if you're driving to work, or like you mentioned, working from home, and you've got a significant amount of hours, or you claim, your mobile phone for work or anything like that, even your tax fees, like we mentioned, if you're claiming your tax return, it's $300 or $400, you get pretty close to that 1,000 straight away. So I think it'll help some people doing their own individual returns. They'll be able to enter the 1,000 in, get another $300 back, or either reduce their tax bill by $300, but it won't, you don't actually just get $1,000 and it won't be automatically applied. It will just replace
Is it like a offset or a credit?
It'll be a tax deduction. So, it'll just reduce the tax you pay. So
Yes. If your tax is zero, they're not going to give you $1,000. Yeah.
No. And same if you've earned 18 grand or 20 grand and you've had no tax withheld throughout the year on that money, you're not going to be getting any money back, from that 1,000. It'll just reduce your taxable income.
Yeah. So sorry, Steph, not this year. And I think it's kind of the same as the work from home stuff. The fixed rate method, it's just an easy way if you're lazy and you don't want to track. But if you put the work in, you'll probably get a better outcome.
Yes, yeah, correct. Yeah. If you keep track throughout the year, and you've got those expenses, then then you can definitely hopefully end up with more than 1,000.
Yeah, awesome. All right, the next question, what documents/information are you supposed to tell the accountant about shares and DRP? Help. There is paperwork everywhere.
There is. So with these ones, I normally palm them off to my senior accountant, Troy. He's very good with digging into these ones and looking all the information up. I would say you need to keep as much as you can, and then give that to your accountant. And but sometimes we can go into the share registry. We can see when it's come in, and if for some reason we don't have that price, we could then look that price up on the internet and then kind of work it back from there. If it's in an ETF or a managed fund, sometimes they work it out for you. So if it's continued, reinvested, sometimes they do the calculations for you, which can be really good. But if it's just say like a blue chip share that's been reinvested, you generally have to work it out yourself, but you can use the HIN number, or some of the other numbers in the registries to kind of work it back from there. But the more information you can give your accountant definitely gets you off on a good start.
I mean, at the end of the day, if you're investing in shares and ETFs, if you're using a broker, you need to be really good at spreadsheets and keeping track of buy events, sell events, DRP events, brokerage and all that stuff. Or plug in your share sites, your Navexa, or do what I do. I don't use a broker. I use a custodian platform, and I've got my consolidated tax reporting and I've got no problem. So I don't know why everyone freaks out about all this crap, because it's like, we'll just get a system that's easy and you do less work. And anyway, that's my shtick.
It sounds, very basic, and I wish all my clients were like you. It would be great. So feel free to bring your stuff across if it's all summarized. But I think a lot of
wish,
clients,
Ben. You wish.
get to the matter of fact at the end and they've sold it. You'd be surprised. There's so many clients, they sell crypto, haven't got any track of any of the purchases. And we have to work it all out for them, which, we normally ask the clients, we say, hey, this is what you got to do. You got to go back and get this stuff to keep your fee down and stuff. And if they don't want to do that, then we tell them the bill. And
because if there was a full on nightmare of transactions, buy, sells, trades throughout the year, and they didn't have the details, you're not going to be like, all right, it's only $100. Like, no, bro, we're going to have to actually spend more time and charge you more. So, if you want to be a purist and have your chest broker, awesome. It'll just cost you more potentially at tax time. Pick one.
Yeah, and a lot of clients, to be honest, a lot of accountants will just start doing the work and then you'll get a big bill at the end. You won't even see it coming, but we try and give upfront costs.
They're like dentists. Yeah. It's every time you go to the dentist, it's this like lucky dip at the end. You get to the counter, it's like, oh, what will it be today? Will it be $250? Will it be $600? Surprise, $1,000. Oh, damn it. Yeah.
There you go. It's gone up 200% this year.
Yeah. So you guys would let people know before you pick up your mouse pointer if it was going to be a bit more crazy to set expectations.
Yeah, we try and as hard as it is, we try and avoid bill shock for clients for our business clients as well as our individuals as well. So if we can see something, I had a client. I think it was probably just a couple of weeks ago, and we said, it's going to be $600 for us to just go through, and you've given us some of the information. We need some more from you, but once you've given us this information, if you can't work it out, it'll cost you $600 more. And she said, yep, I don't want to do it, Ben. Go for it. And then I said, here you go, Troy, please do this for me because I do not want to do it.
There you go.
He's a whiz. So yeah.
Ben's just like the model that goes on podcasts and advertises for the business. I see what it's like.
The face.
That's right.
If you're after personal financial advice, don't get it from a podcast. But if you want guidance tailored to your situation, head to moneypodcast.com.au and click Get Help. We'll connect you with one of our trusted professionals, financial advisors and mortgage brokers, who work with people right across Australia. No matter where you are, they can help. Now, before we get back to the show, a quick reminder to protect your financial life. That means having income protection sorted. It means having death cover if there's any debt or dependents relying on you. It means getting your personal insurance in order. Most people insure their car, they insure their house, but what about themselves? Sky Wealth, who support this podcast, are specialist financial advisors who can help you get the right cover in place. Their advice is often more comprehensive and better value than going direct through your super. Book a complimentary 15-minute chat at sky.com.au. That's skye.com.au. And they'll point you in the right direction.
Okay, we're now talking about Division 293. There's a question here. I'm over Div 293 territory. Is it still worth salary sacrificing over the max cap? Now, do you want to explain to people what this Div 293 is?
So if you're combined adjusted taxable income plus your super contributions is over 250,000, you get hit with an additional 15% tax inside your super fund. So normally you would get taxed at 15% on your contributions in your super fund. This adds an additional 15% on some of those contributions that are over the 250. So your total tax in your super fund will go up to 30,000 instead of 30% instead of 15%. Now, you get sent a letter after you've done your tax return and they've worked out all your contributions and the extra tax you have to pay. You can opt to have this paid out of your super fund, which a lot of people don't know about because the letter has a lot of words on there. And generally we will have the clients email us back to say, hey, Ben, can you please take this out of our super? And then we can lodge a form to have that money come out of your super. Now, regarding the cap, so if you're earning over this 250, you can probably afford to see a financial planner. So I would probably recommend that you see one who can help you do the numbers to work out if it's worth doing this. But from a tax perspective, yes, it is still beneficial to go over the cap. over the 30,000 cap, especially if you've got the carry forward. So if your super balance is under the 500,000, you potentially have carry forward from the previous years that you can use to go over that 30,000 cap. And generally from a tax perspective, it is still worth it. If you breach your cap plus any excess carry forward, it's generally not worth it, because then you've got an excess contributions tax, which will then, that amount of money will just come straight back into your tax return. You get taxed at 47%. So generally it's not worth it. But I would recommend seeing a financial planner. It kind of leans into that territory, and you would have a conversation from that point.
Yeah. So there's actually an interesting anomaly that's going to happen from the 1st of July if you earn over $250,000 a year, right? So if you earn as your employment income $250,000, we know that 12% of that is $30,000. So we're at our cap this financial year. But next financial year, the concessional contribution cap is increasing to $32,500. So we're in this cool spot where from 1 July next year, if you are earning $250K, you can salary sacrifice an extra $2,500 per year into super as that cap, right? Now, the questioner was like, well, do I still contribute if I'm getting taxed 30%? Well, where I'm from, 30% is still less than 47 outside of super. So it could be a little window here if we want to save an extra maybe $2,500 a year in a tax effective environment for our future. So I think, is it worth salary sacrificing over the max cap? Well, it is if you want to build wealth for future you, if you've got contributions, a gap between your SG payment and the $30,000 cap over the last 5 years, if there's space there, yes, it could be. Ben won't say it, but I've got a license to give general financial advice, and I think generally paying less tax and building wealth for your future is a good thing if you've got the money spare and you're in a position to do that. So, it's just a very interesting anomaly how the concessional contribution cap is going to $32,500 from the 1st of July.
Yes, I would agree on your general advice. That was very good. It'll make a great reel.
Oh, thank you. All right, let's talk dirty. I'm trying to make this accounting episode sexy by using words like talking dirty. This question here is there someone to record? I think they mean, is there somewhere to record a capital loss if you aren't ready to include it in your tax return? Is there a waiting room to offset in future years? So maybe someone thought they were onto a winner, bought the shares, it took a bath, and they lost 10 grand. Can we put that 10K loss aside? I mean, I don't know why you would if you had tax to offset, but that's just me. What do you reckon, Benny boy?
I think you can't choose whether you apply the loss or not to your gains. You would record the loss in your tax return if you've sold the shares. It would then be applied against any gains that you've made from a capital nature. You can't necessarily be like, actually, I'm only earning 20 grand this year and I want those gains to be included because I'm in a lower tax bracket. I'm going to hold on to these losses to the previous year. You have to apply them in the year if there's capital gains. If you don't have any capital gains and you make a $10,000 loss, that'll just carry on forward until you make a gain. So,
or until you die.
Until you die. And then I believe it just disappears at that stage.
I used to, when I was training to be a financial advisor, one of the people that was helping train me, it was always like, you can carry a capital loss to the grave. So there you go.
It's stuck with you. Yeah.
Yeah. Unless it's in the trust, it stays in the trust.
That's right. You don't want losses in a trust.
Yeah.
Unless you've got gains.
Let's talk. If I'm electrifying an investment property, switching from gas appliances to electric over this financial year and next financial year, is that claimable as a repair? So I know, let's just say we're pissing off the gas stovetop, putting in electric stovetop. It was $900 installed. Don't know how much they are, but whatever. And then we're replacing $1,200 gas hot water and putting in electric hot water. Again, don't know why, but whatever. Maybe they're getting solar or got
changing
solar.
some appliances as well, maybe.
Yeah, that's right. I don't know. But so what do we do with these capital costs? Because they're of capital nature, right? Because it's not a tin of paint.
Yeah, that's correct. So if they're most likely not going to be classified. They're repairs or improvements, but if they're over $300 and you got to depreciate them over their effective life, so like you said, the $900, you would work out what the effective life of a stovetop is. Off the top of my head, I have no idea. But then you then get a little bit each year, so you wouldn't be able to claim it all in the 1 year. If you were repairing the door or something on an oven, which obviously you're not, you're changing everything to electric, then you could claim that as a repair, even if it is over $300. If it's a repair and you're actually fixing the appliance, or if you're repairing the same water unit, you're not actually switching it out, then you can claim that. But if you're switching them out, then you've got to depreciate them if they're over $300. Say you were to change the switchboard across as well, or anything else that's like fixed, you did like some renovations, then that would be claimed at 2.5% and depreciated each year at a very small amount. And if you were doing substantial renovations, you would look to get a depreciation report done. So then they would come in and value all those things that are fixed in the actual building itself. So
question for a friend, aka me. I've got a property, and I think this financial year the oven shat itself. So I'm like, all right, get an oven. So electrician went out, just measured, make sure it was. I said, get Westinghouse, for example. Don't get some crappy brand no one's heard of. Like, I like to pay for quality because hopefully quality lasts longer than cheap. Probably, who knows? And I think it was like $900 installed or something like that, right?
Yeah.
On the invoice, and it is probably a question for my accountant, but my accountant right now is sitting in front of me for the purpose of this. On the invoice from the electrician, if it was like $700 of capital, like the actual oven, and $200 install fee, would the accountant split out the $200 and put that or just the whole $900 is the depreciation?
Yeah, so the whole amount would be all as part of the asset. Unless for some reason they put repair and, I don't know, separated it, which would be incorrect. So the same as if you order something, the shipping normally falls into the purchase price and then you depreciate it all together. So unfortunately this was part of the install, this was the actual asset. It's all part of the asset because you needed it for the install and it's all associated to the
I should have got a friggin' invoice. Give me an invoice for the oven and give me one for quoting repair works or something like that.
Yeah, I'm not going to comment on that, Glenn.
No, neither.
You can talk to your mates that are electricians and see what they can put together.
If there's one thing, I do everything straight up because I do not want the drama of please explains. And you get to the point where it's like if it's a $900 job, right? The $200, if we did get cute and do different invoices, like it's just, what are you doing here? The amount of drama to manufacture that.
Saving yourself $60 or something maybe.
Yeah, like what are we doing? But no, I was just curious if they did actually carve out the actual asset or just bury the whole thing as the cost. So, no, makes sense. All righty then. Lulu, as a 22-year-old who still doesn't really get tax returns, how serious do you actually need to be with receipts and deductions? Do people keep everything or just major expenses? Could you break down the realistic approach really simply? So let's just assume Lulu goes into the city each day. She works on level 42 in the Salesforce Tower in Sydney or whatever, admin role, goes to work, goes home, doesn't have any investment properties yet, maybe has an ETF portfolio or something like that. Lulu doesn't really get returns. So, Ben, can you make her get them?
We can definitely ask her questions and tick things off. From her question of keeping receipts and invoices, you having gone through those, 2-3 audits in the last 17 years, when they do audit, they ask for everything. So if you've purchased shoes for work, if you've used your mobile phone, they will ask for invoices, receipts, proof, absolutely everything. So obviously there's things that you can claim without invoices and receipts, but like, for example, the motor vehicle expenses, say she's working admin and driving to different branches around the city, they will potentially ask for a letter from your employer. They will ask you to justify how you came up with those kilometres. And even though you don't need a logbook to do the 5,000 Ks, you still have to have some sort of grounds for your calculations. So if you're buying it for work, I would say, regardless if it's a $10 phone case or something like that, you would take a photo of the receipt, stick it in that OneDrive folder or the Google Drive folder or anything like that, and just have a digital copy just in case you need. And you only have to keep them for 5 years. Well, I say only, but 5 years is probably a bit of time. But they'll fade if you keep them for more, those 5 years and you haven't taken a photo. So
what I do on my personal Dropbox, I've just got a folder called tax, and it's got from like all the financial years. I've just got a folder that I create at the start of July, the first receipt or invoice or something that's of personal nature. I just create a folder on there. 2027. In July, I'll create my folder, and there'll be like investment property folder. There'll be like, I don't know, share folder or whatnot. And then I would say to Lulu, anything that you buy that you think is to do with your work or your job, it won't do any harm to, as you said, take a photo of the receipt and just put that in that Dropbox folder. And I just do it as I go each month. Even, I was at a cafe the other day, and on the coffee machine, the barista had a GoFundMe, wanted to do 100 push-ups for some charity. I'm like, I'll help the guy out, and, scan the QR code, donated some money. As soon as I got that receipt in the email, I put it in the Dropbox folder. Done.
Yeah. A lot of I do the same as you. I've got my investment property folder, and I've got all your deductions folder as well. But then another thing that works well is, like you said, you've got an email, so you can create an email inbox folder, and you can just drop and drag it straight into that email folder, and you've got it all. And like you said, if you've got more than less, it's better off. When we do the tax returns, we don't necessarily have to see them all. You can still just add up all of those donations and say, this is how many we had for each different charity, and this is the amount. You don't need to send us all the receipts. You can upload it to our checklist, so it is all stored for you for the 5 years, because once it's uploaded into our portal, it'll carry forward and we'll have it for you. But we don't necessarily need to see all those documents and receipts. You can just give us a summary, you hold on to them yourself, and then you can pull them out if you ever get audited and need to.
Is your checklist on your website?
No, so it gets sent out once you book an appointment. If you book,
do you have a PDF of that or something like that?
I don't. I'm sure I could pull something up, but it's got all our trade secrets in it, so maybe.
All right, we won't, because what I was going to say is, if you're watching on YouTube, we'll put up the overlay of the checklist, but you're basically going to be asking about basic work stuff that people might not realize, like if someone had to have a work phone and they were worried that they were going to drop it and they bought a $50 case for the work phone, all day long, I'm going to claim that.
Yeah. So the questions are basically like, do you use your phone for work? Yes. Did you buy any, any cases or any, equipment for that phone? And it goes on from there. But obviously, if you're seeing an accountant, you don't want to just go on and do a checklist. So once we've got that checklist, we'll go through. If we can see, hey, you're in this occupation, you might have this, we'll then send you an email and say, you might have missed this deduction, can you send them through? So we make sure we're asking queries and checking stuff off as well, if we think you've missed anything. Yeah, so
Lulu, yes, keep everything, minor and major, and just it doesn't do any harm, and your accountant will let you know if you can use it. Okay, let's finish this off, and gosh, so boring tax crap, but here we go. To use or not to use the 6-year rule on the investment property we sold this financial year. Okay, I'll buy it. Its growth matched our PPOR, but our PPOR has massive future growth potential, and I'm not sure if exposing it to CGT liabilities for the 6-year window is a smart idea if we intend to sell it in 5 to 10 years from now. But I'm also not excited about a huge CGT bill this year. Do I just need to take my medicine and accept my reality? Yes, you do. Actually, Ben, on that, you can't turn around and say, well, that investment property that we've never lived in, we're using it as our 6-year PPOR rule, right?
Not if you've never lived in it, yes. But I read this question as they have lived in it and then moved out. Is that correct? Yeah.
Yeah, well, I guess probably.
For the purpose of the question, we can probably, answer it like that. And this would be a question that you would sit down with your accountant and get personalised advice on, because you need to look at all the different figures and the numbers. But initial thoughts would be claim the main residence if you did live in it, because then you're just going to defer the tax potentially down the track. So then the longer you live in the one that you're living in now, you will then push it down. You won't pay the tax until longer on, time value of money, etc. Might be a bit worth something. But the other thing people don't know as well is that when you move out of your primary residence and change the purpose of the asset to be investment, you need to get a valuation done, a backdated valuation to that date, and that's your new cost base. So say it's gone up 200,000 since they were living in it, and then they move out, start renting it out. You get a backdated valuation to that date. That's your new cost base. That cost base is what you use to work out the capital gains, but you can apply the 6-year rule from then as well. So say you lived out of it for 10 years, you could apply the 6-year rule for 6 of those 10 years. Your cost base is the new valuation as well. So you're only then going to be paying tax on 4 of those years at that new cost base. You've obviously then got a few other levers you can pull, like the 50% discount for holding it for more than 12 months, and a few other things. Obviously,
only if they do it. Yeah, ASAP.
Change, but yeah, exactly. Yeah.
The thing with as a general rule of thumb with tax, you will have to pay your tax, but the best tax planning is to kick it down the road and pay it later, right? Because either that money that you would have paid tax can still be invested and compounded, or even if you've sold the asset, you can keep the cash for a year before you pay the tax and lodge it on the last day and all that stuff, right?
Yeah, I say that's correct, unless, like in this case, if for some reason they were going to get a giant pay rise, which is going to push them into a larger tax bracket, and that was going to significantly change it. So then it just depends on the situation.
So for this question, pay a few $100s and get some actual advice on the tax outcome, and the advice will pay for itself.
Yeah, definitely. And then you've got no surprises, and you're ready to go.
Okay, last question. We've sold some investment properties and have a CGT bill coming. What can we use to reduce it, both the obvious and not so obvious? Thanks.
So it probably covers off some of the things that we just spoke about. Your 50% exemption if you've held it for more than 12 months. You could do some contributions into super, assuming you've got ahead of it and had a meeting and worked it all out before the end of the tax year. There's a few different things that you can put in place. Like we just mentioned, if you've lived in it, then you could get a cost-based valuation from when you moved out, the 6-year rule as well. They're probably, the ones off the top of my head. You might have some losses as well carry forward, which we touched on earlier. So you could apply them against there as well.
Yeah, they're really, particularly when these changes get put to bed that the government has proposed, like this 30% floor is going to make tax reduction harder, just factually, because if you made $100,000 gain and you had $100,000 carry forward caps available, right, you can't just put the 100 in and not pay any tax and just pay the 15% in super. You'll pay $30,000 off the bat, then that remaining $70,000 you can contribute to super.
Yes. You're telling me. So, That sounds great.
Yeah, I mean,
to be honest, I'm still trying to get my head around all the rules that have come out. And because they haven't been legislated, I haven't really dialed down on all of them just yet. But
and that's the risk that, I've been like, it's not worth me really learning and getting absorbed until the ledge is like put to bed, because sometimes, because I'm a bit basic, I'll learn all these rules and the ledge will get put to bed, and then I'll recall the rules that I learned before it was put to bed, and I'm like, what am I doing here?
Yeah, I do the same with all that. We have changing every year, all the caps, all the limits. It's hard to keep on top of them all the time. So, but I guess, you've always got the internet and things you can look up and check on specific circumstances. Yeah.
Now, in finishing, is there anything that you think is important that people need to know about their tax return? Like, they need to know this right now, this first week of June. This will probably go up on the 4th or the 5th of June or the 6th, like something they need to actually know right now.
I would say those questions are really good. We've covered a lot of things. One of the main things I would say is if your accountant isn't asking questions about, your industry and what you're claiming and going back and forward with you, he's just putting in what you're, or just bringing to him or them, you should definitely look,
you need to check your privilege, you bloody guy.
Yeah, you potentially do it yourself. So, and then I guess the only other thing is if you're going to put super contributions in, you want to get them in before 30th of June. That's probably the only one. Other than that, I think, keep all your receipts. You'll need them. Stick them in your folders and your emails. Yeah.
So on that, I wrote down as you were talking the timing. Like, this is all that matters. So if you're like, I've got $10,000, if my carry forward cap, or even just my cap this year, and I want to make a contribution to super, the timing is everything. If it drops if you transfer it the last day of June, it leaves your bank on the 30th and happens to be a weekday. Is it a weekday this year? Let's just have a look. I'll get my diarrhea up. Yeah, so the 30th of June is a Tuesday, right? So don't log into your internet banking on the 30th of June and go, I'm going to now put my 10 grand into the super fund. Friggin' do it the week of the 15th for extra issues, because if you put the wrong code and it bounces back, you got time. If it takes 2 days to clear through BPay, it will appear on your super fund on the 2nd of July, and that doesn't help you. It needs to be in your super fund on a day in this financial year. Same with charitable donations is a bit different. You just got to make sure the receipt that the charity gives you says before 30 June. So if there's some weird thing and you log in on the 30th, you go, I'm going to make all my donations now. And for some reason their processing thing does it and it lands in their account on the 1st, and they give you a receipt that says the 1st of July, it's too late. Like,
and I guess,
yeah.
Sorry, I was going to say separate to that.
Are you interrupting my rant? I think you are, but
rant.
Go on.
Sorry,
go on.
No. It ties back to that, the assets we're talking about and buying for the investment properties, but something that we do see a lot of people see a laptop, end of financial year sale. They'll buy it on the 29th of June, and then they'll come in and see me and they'll say, Ben, hey, I've got this $1,000 laptop. Let's claim it, and I'm going to get the whole amount back. And I'll say, well, you've had it for 2 days of the tax year. It's more than $300. Therefore, we're going to have to depreciate it, and you can now claim $30. So it's not the whole amount. So that's another common thing as well. If you're looking at getting it, just keep in mind you're probably not going to get all of it back at the end of the tax year for assets over that amount. Sorry to interrupt your rant.
No, it was a well-timed interruption, because it does speak to that. I'll buy this to get the tax back. So if I did buy it on the 1st of July and it was $1,000, you don't magically get $1,000 back in your tax return. The government aren't in the business of giving out free money unless it's a crisis.
Exactly. I've seen that with donations as well. People think, oh, wow, I can donate to this, charity, and I'm going to get all the money back at tax time anyway. So why wouldn't I do this? It's just a cycle, a loop, but that's not correct. Yeah, you just get the tax back on it.
The bush maths way to think about it, everyone, if your tax rate was 30% and you spend $1,000 on the item, you will get $300 back. You've still spent the $700, friends.
Yeah.
So
and
we're not
on
doing
that-
things just for the tax.
And like you mentioned, if it's $1,000, you're going to be depreciating it over a couple of years, depending on what you purchased and its effective
Yeah.
life.
Well, maybe I'm talking more for the business owners.
Yeah, correct. Yeah.
So if you want to buy a new little drill at the end of financial year, it's a $3,000 Milwaukee kit or whatever, I'll buy it to get the tax back. Bro or sis, no. You're like, no, you still spent the net effect. So
Yeah, which touches on the $20,000 instant asset write-off. So many people think $20,000, wow, I can't wait to get that back. That'll be great. But it's just what you can claim up to. Yeah.
That's right. Well, my friends, I'm going to leave because I'm done with you, Ben, and I think we've answered a heap of questions, but we'll have to get Ben back on to talk tax again. What's your business called and your website, and where's the best place people can go if they want to get your team to do the ITRs this year?
We're called Aevum Accounting. You should be able to put that into Google and we should pop straight up. Aevum Accounting.
No one knows how to spell it, mind you, Ben.
So it's AEVUM and then obviously accounting. I am dyslexic, that's why I deal with the numbers. So I made sure I had something I couldn't pronounce or spell.
Yeah, love it.
But yeah, there's a booking link. They can either book in a 15-minute consult if they want just to check, or they can flick us an email and we can reply with onboarding forms and our prices and anything else that they need just from the website. So, yeah.
Love it. Well, there you go, peeps. If you've learned one thing, don't leave it to the last minute. Get on it right now. Simple as that.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.